Welcome to the show. Today we have Mr. Andre Cronje, a legend of DeFi, and I'll allow him to introduce himself.
You're putting me on the spot there right at the start, eh? I never know how to introduce myself. I normally just, I'm a builder building things. I think a lot of us are kind of just fumbling around in the dark in this space, right? And trying to see kind of what sticks. But I mean, I guess that's how it is with any new frontier. Yeah, I've been a coder all my life. Started as a lawyer, actually, but quickly realized that's not for me. Spent the majority of my 20s building boring standard banking financial software and some telecommunication stuff. Around my mid to late 30s, got involved into the blockchain scene. First as a critic, but eventually converted by the fact that there was something more here. And spent now almost close to a decade building, financial primitives, blockchains, wherever I see an opportunity for something to be done better, try and do it better. That's really it.
Awesome. Yeah. And I, of course, have been aware of your work for about almost half a decade at this point. I built some of the most important primitives of DeFi Summer, and then some other primitives that are still used today, and then Sonic, which we've been talking about recently on this channel, and I think is one of the few chains that's actually had growth across all the major metrics over the past couple months. So you want to talk a bit about what Sonic is for people who maybe aren't aware and what makes it unique?
I mean, Sonic is Fantom version 2, I guess I can call it. And Fantom was, I'd say, probably the first real high throughput blockchain. I mean, it's the oldest EVM blockchain out there other than Ethereum itself. Fantom's, now Sonic, objective was always blockchains can still be a lot faster than they currently are. Originally with the first network, Fantom, that was launched, it was significantly faster. A downside, I actually think, with Fantom is that it was released a little bit too soon. It's before we really started seeing financial primitives. It's before we really started seeing DeFi. It's before the landscape that it is now. 2018 towards the 2019, when it really launched, there wasn't really a DeFi ecosystem. There wasn't an NFT ecosystem. There wasn't meme coins, GameFi, none of the stuff. And I think back then everyone was still kind of trying to figure out what to do with a blockchain. I remember us doing so many POCs with supply chain and identity and smart cities and a bunch of crap that just never, stuck. So anyway, a little bit too soon. It was also launched at a time that bridges didn't exist. So there wasn't any easy way to get assets across or move. Anyway, so fast forward, back then I'm getting a little bit stuck into the why it didn't capture as much market share as change that came after it. Because Fantom, being the first high throughput chain, you could argue then it should have had more market share, but it was very easily overpowered by chains like Avalanche, like Solana, at that time, Polygon, because they were just as fast. But they had bridges, they had infra, they had, burgeoning DeFi ecosystems, things that, because we launched early, could have never really been addressed. But anyway, I'm giving this background just to contextualize that, even back then, we had already solved what we then thought was the biggest bottleneck, which was really consensus. Back then, everything was proof of work, and that is a design choice limiting factor, because proof of work is going to be as fast as your target is. So your block times are kind of fixed. It's not based on hardware. It's not based on network. It's just if it's going to take 30 minutes, it's going to take 30 minutes. The end. So replace that with our ABFT consensus, which is what we're actually still using today. I still think it's the gold standard and consensus. I don't think there's anything faster other than pure leader-based solutions. But if you want to have a leaderless system, then I don't think there's anything faster than it currently on the market. But so back then we realized that the consensus, the raw consensus, so if we just do transfers, we can pretty easily hit upwards of like 50 to 60,000 transactions per second. But our absolute max throughput at the time was between 180 to 200. Now, why was that? Now, that the entire limiting factor was the EVM, because the EVM was not designed to process more than an absolute upper limit of about 200 transactions per second. This was 2019. There's obviously a lot of advancements that has happened since. But so we recognize that the EVMs are our largest bottleneck. And so we spent from basically 2020 till last year, 2024, trying to figure out what we can do. And it started, back in 2020, it was a little bit throwing darts at a board. It wasn't a particularly informed methodology. And we had thought there's a bunch of stuff that made sense, like parallel execution, for example, is always one I get stuck on. During that time, we were fortunate enough to, build our treasury to the point where we could start hiring some real expertise, not blockchain expertise, but very focused niche expertise. So compiler, VM, bytecode, the small components that make up a blockchain, but not the blockchain itself. Got some of the best experts in the world. I always mention Professor Bernard Schultz out of Sydney, who, basically attributed as one of the forefathers of VMs. And they immediately brought a lot more of a traditional perspective to building, in that they decided, hey, okay, cool, we have all of these ideas, but we need to test these ideas. Otherwise, there's no point spending 2-3 years building out something then to realize it's not going to work. So they spent about a year building a tool called ADA. ADA allows you to replay blockchains in hours instead of years. If you try and replay the Ethereum stack now, it'll take you months. And we needed a way that we can quickly be able to do this so that we can then iterate over prototype changes. This allowed us two things. This allowed us a bunch of output metrics to be able to see where is time being spent, IO, CPU, RAM. We can contextualize everything. So we can see where in the stack are we losing time and throughput, and that we can then rapidly prototype and test. So we ran it through, and the biggest bottleneck by far ended up being the database. Traditionally, even standard Go Ethereum, everything else, they use sort of out-of-the-box databases, BadgerDB, LevelDB, PabbleDB, in-memory database, all of these different kinds of things. But now, the problem with an out-of-box solution is that it is somewhat generic for the problem at hand. A generic database does a bunch of things that it assumes it is optimizing for structured query language, SQL, or whatever, interactive method you have of going through data. So to optimize for that, it does a bunch of things in the background. It builds in indexes on top of your primary keys or any, specific strings or so. So there's a lot of things for each bit of data you save that's happening in the back end that end up making these databases the biggest bottleneck. And when I say biggest bottleneck, so when we threw away the standard databases used by most and we developed our own custom one called CarbonDB, which is hyper focused and optimized specifically for EVM structured data. So this is compatible with any EVM system out there. And we are actively doing some BD to try and get some, other clients to adopt it, because even Ethereum can adopt it raw out of the box and get a huge throughput increase. But so to contextualize that, when we switched, our on disk requirements, so our node requirements went from terabytes to tens of gigabytes. So it was a storage reduction of over 98%. which in itself is already enough of a benefit. But then read and writes in terms of I/O, CPU, and memory also increased by 8.1x factor, so about 810% increase. So I mean, right there, you're going from 200 to 810% more throughput, with the benefit of the lower the storage as well. And then the next thing we saw is something like supersets. I'll try to keep that kind of high level, but when there are certain instructions that on the EVM happen very frequently. So if you look at an ERC20 transfer, it goes through a few steps. The first thing it does a read from disk to see, do you have sufficient balance? It does a read to see the guy you're transferring it to, what's their balance. Then it does a subtraction from your balance. It does an addition to their balance. Then it stores your new balance and it stores their new balance. Few other steps. I'm oversimplifying. But so, that's basically right there is already six distinct things happening, and each distinct thing has its own little bit of overhead in terms of its start and its end and how it's supposed to interact with the registers and these kinds of things. A superset goes and, hey, instead of doing these six things individually each time, let's create an opcode that's ERC20 transfer, and that's all you call, and it does all of these things for you, and it can do them in parallel as well. So that's already a big throughput. Now that one is less generic architecture. And what I mean by that is, right now, for example, the ERC20 transfer opcode is one that makes us very, very fast. But if tomorrow people stop doing token transfers and there's some kind of new standard that comes out that doesn't work that way, then we have to analyze and introduce that new superset. But that's an iterative process we can keep doing. But that's not a generic solution that kind of applies to everyone. That's very specific to our VM. And we just went step by step through a bunch of different performance engineering exercises like this, tweaking where we can get more throughput, until where we are now, where we're very comfortable with our peak on-chain was about 16,000. But we can do comfortably between 15 to 20,000 complex transactions simultaneously. So I'm talking about, when I say complex, I mean like flash loan level complexity, loan there, swap there, deposit there, close that, liquidate that, return the original thing. I'm not talking about basic ERC20 transfers. Basic ERC20 transfers, you can up that number probably upwards of 50,000 quite comfortably with the current VM. Raw transfers, we're over 600,000 by now. So that in itself required that the new VM and the new database required a fresh stack. So normally in blockchains, what a lot of guys do is they'll do a soft fork, which is where you just upgrade the node software and everyone's in parity. Or they'll do a hard fork, which is potentially where there can be a break in the chain, and then everyone needs to update to the new validator, but then that works fine. In this case, we couldn't import the historic data previously because our VM does respond and act differently. It does create the potential of a lot of issues that could crop up that we couldn't necessarily test or plan for. So we needed to launch a new network. So we would have had a new network in any case, and sort of our internal name for the project was Sonic, and that just ended up becoming the public name. And then, we figured, well, let's do a whole branding exercise along with that, and that's now the Sonic chain that we have launched. So right now it's technologically and practically probably it is the fastest chain out there currently. Not just in terms of like pure throughput, because I can modify Ethereum to do 1 million transactions per second, but your wait times are gonna be like 15 minutes until a transaction is actually finalized. We also hyper-focus sort of on that user experience side. So our finality is also the lowest of anyone, and we have true finality, which to my knowledge, only Avalanche is the other one that has that. In that, there's no longest chain, there's no probabilistic finality. Once our network sees a transaction, it's finalized. That finality happens, sub 100 milliseconds. Block propagation then goes to about 280 to 300 milliseconds. But what that basically means from the user perspective is, you click on the submit or the swap or whatever button it is you press on, and it's instantaneous. Like your transaction will be confirmed before the app or the wallet you're using even tells you it's finalized. Which is actually one of the things we're currently doing with a lot of teams. We kind of have to get them to update their UI so that they stop using these asynchronous patterns and they start using these synchronous patterns. That's a different story. So we have this really, really fast blockchain, but I also think that matters a little bit less and less nowadays, because there's a ton of really fast blockchains out there. So sort of parallel to that, the necessity of having a new fast blockchain, I think, is twofold. One, it is required for us to be able to build new apps. So right now, only really financial primitives are what makes sense. Yeah, I'm going to stop talking there for a second because I think I've been babbling for far too long now.
No, that was phenomenal. Thank you. Yeah. So to that next point, I think, like you were saying, there's many fast chains now. What there's a real demand for is apps to use on those chains. So what sort of apps does Sonic's speed enable that would have been impossible in the past? And what are you already seeing built on there?
I mean, for now, every new technological lift has a delay. So what I mean by that is, when we went from 56K dial-up modems all the way to fiber, the day fiber was released, we didn't automatically have high throughput apps. We didn't, like, the next day have the Instagrams or the Snapchats or whatever of the world, Reddit, even anything that's image heavy. It took years after the base layer made that possible until it started coming out. Blockchain's no different. So right now, the apps we are seeing is still predominantly based on what the previous max throughput allowed. So that's AMMs, that's DeFi, that's basic trading, that's some sort of early 2000 style flash gaming. And we will continue to see them, I think, for the next year or two, probably. This technological lift, however, does allow a new generation of development to begin. And I think we'll see more social things, chats, streaming, definitely more gaming. We can already see those evolving quite rapidly in our ecosystem. But over the next, 6 to 12 months, you'll still predominantly see decentralized finance primitives. But I consider that in itself a really, really good thing, because I think there was a lot of innovation and effort happening in DeFi up until maybe the end towards 2022, and then it all kind of fell off of a cliff. And there's still a lot of room for innovation. We did not hit the ceiling there. So there's still a lot of things, insurance derivatives. There's so many markets still that need to come online in terms of decentralized finance that we haven't seen yet. And look, it was partially also prohibited by the capabilities of the underlying infrastructure. But now that we have that, I think it becomes a little bit more easily accessible for all of these new things to actually come online.
Yeah, absolutely. And to give viewers of this some context, looking at the DeFi Llama page on Sonic now, it's probably attracted the most new DeFi apps of any chain this year. I see over 70 tracked there.
And I mean, it's only March, so the year's still early. But yes, for now, it definitely has the most aggressive expansion. But that's a combination of apps want to expand to new territories. The chain users are quite sticky because they find it nicer to work with. And then yeah, we've been lucky to attract quite a bit of organic TVL, which is also nice. And you know, this isn't like lock drop or pre-deposits or anything like that. This is actively deployed people doing things actively on chain. So I think that sort of has its own little flywheel effect. Because a lot of chains have, you know, basically passive liquidity, people that deposit something and then never really do with this. Ours is currently quite active. So even when something new deploys, it quite quickly attracts a lot of deposits. You know, an example is Euler, however you want to pronounce it. You know, they've been on base for quite a while, deployed. They recently deployed on us. They're already higher TVL on us than they are there. Ava launched yesterday. Within something like 6 hours, they reached all of their caps, which is like $35 million or something. So it's a lot of TVL that moves quickly, and I think that attracts people to try and new things and experiment again, which in itself is good.
Yeah. So how do you view that DeFi flywheel with TVL, volume, fees, etc.?
Well, I think at a chain level that flywheel was broken for a long time, right? I think we even saw it on DeFi apps. I mean, the most sticky / quickly growing apps currently are all VE33, which, you know, is my tokenomics design I did with Solidly. And we're seeing most new chains, their biggest AMM quickly becomes their VE33 AMM, whatever it is. We haven't seen that apply to lending yet. I think we will soon. But the point being, so why did VE33 work quite well? Because it did the correct incentive alignment between participants. You know, previously it was either just the LPs were incentivized or it was just the token holders are incentivized. And this VE33 in design is a nice split between those incentives. Why do I say that was never right on a chain level? So if you look at any blockchain out there, let's take Ethereum as the default standard example, and let's take their biggest app, Uniswap. Uniswap has generated $2.8 billion in fees for validators, of which Uniswap generated 0 of that for itself, and it generated 0 of that for its LPs. That's misaligned incentives right off the bat. So another thing there that we're, for example, hyper-focused on is making sure that we fix those incentive alignments, which, you know, has shown to work in my previous iterations. So one of the main things I think that's also attracting a lot of experimentation and allows people to test stuff without needing to raise a lot of money is our fee monetization. All that does is 90% of the fees generated on chain by users using our apps goes to those apps. They flow back to those contracts instead of going to the validators. So in Uniswap's example, you know, they would have earned what, $2.4 billion in fees. Currently, the only way apps can capture that is basically to launch their own L2s. And we're seeing that. We're seeing big apps launch their L2s because they want to capture those fees. And I don't blame them. It's big numbers. Or, you know, they can deploy on something like Sonic. They can have those fee captures and they don't have to take on all the other overheads. Because I think something that is often forgotten is that launching a new chain has a lot of hidden costs, whether it's getting a third-party explorer, an RPC, a wallet, an Oracle, doesn't really matter. All of those things cost money at the end of the day. And we're not talking about, you know, a few cents. We're talking about tens of millions. So I think a big focus for us currently is getting those incentives aligned appropriately. So for example, another one is our chain having such high throughput means that execution and storage costs very little. So our fees are as low as you can get in blockchain. The problem with that is, you know, now if you have an app that only has, let's say, 1,000 transactions a month, and they could be high value transactions, but there's just not high volume. For them, all of a sudden, it doesn't make sense, you know, because now they're not really earning as much. They'll earn, let's say, 0.001 cent on their 1,000, so they get like $1 or whatever. So in that instance, we also recognize that not all fees are made equal. And so for that, we're launching a blockchain level module called dynamic fees that allows the contract deployer / multisig, whatever they want to configure it as, to set the fees on those contracts. So if it's something that generates a low volume of fees, but it's high value fees, you can set those numbers up higher. And that's equivalent to, you know, a company that sets its subscription cost, whether that's some stuff you're willing to pay 99 cents per month for, other stuff you're willing to pay $900 a month for. It all depends on the value you're busy getting out of that. But so we're spending a lot of time this year focusing on how to get those incentives just right, so that the apps have the most benefit, the validators still get enough for their security, and it potentially, you know, trickles onto the user as well. So I'd say that's, I don't know if that really answers your question in terms of the DeFi flywheel, but you know, that's sort of our core focus, is just how do we get the activity that these apps generate for us back into their pockets.
Yeah, it answers. I do have a few follow-up questions. So those dynamic fees, will they be immutable, or can they be adjusted based on?
They can be adjusted. So I mean, because you never know, right? Like you can deploy and charge too much, and then you don't get enough users. It's as with anything in the world, you know, you need to adjust your fees for inflation, for your user base. Maybe you charge too much, you need to make it less. Maybe you're charging too little, you need to change more. So they can change them as and when they're required.
Great. Yeah. No, that makes total sense. And then going back a little bit, when you were talking about V33, you mentioned how, if I understood correctly, that had not been applied to lending, but that it could. Was that right?
Yeah.
Yes.
It can be applied to 99% of apps out there, because, you know, anything that generates fees, the model can be applied to. It's that simplistic. So I think we're still going to see a lot of sort of innovation on the tokenomics side. We're already seeing some of it. You know, Shadow on Sonic is doing quite well there, I think. They've been changing a lot of the stuff. So the original thing was like a 4-year lock, and they've now changed that to 180-day vesting. There's no default lock, and then 50% penalty if you want to early exit, which is definitely inspired by sort of the original Ellipsis model that was built on top of Curve. But then on top of that, they still made a liquid asset X33 that you'd expect to work at the 50% value parity, since that's the exit cost you're taking for immediate liquidity. But then because it's accruing a ton of fees, those fees are used every epoch, so every week, to bid the X33. So that has implicit buying pressure there. So it's trading at about, I think, 80 to 90% parity at any given point of time. But again, you know, that's a bunch of new experimentation that I just love to see. And I think we also try and, you know, our users are quite informed, and we try and make sure with our messaging to also explain the different risk tolerances on the different apps, you know, because there's some really high risk stuff, but they're trying new things. And I'd rather still support them and say, hey, these are the new things they're trying. This is how all the ways it can go wrong, but, you know, let's see what happens. It's just nice seeing that again, you know, because it feels very much like the original sort of 2020, 2021 spirit of Ethereum, where people are willing to try again. They're willing to innovate. They have informed users who are willing, that are capable of understanding the risk. Because a big, not a bad thing, but a big problem thing that happened towards the end of that sort of DeFi cycle is it started attracting a lot of uninformed users who did not understand the risks that they were partaking in. And that's when bad things happen, because that's when expectation management starts messing up. But if you have informed users, you know, even if something collapses, they don't start screaming for, you know, the pitchforks and the torches to burn the whole place down. They accept the risk they took and they move on. And I think that's important, because I think that's something that's been lost on a lot of other chains. But again, it's a function of your users, right? Like as the liquidity grows and it attracts more passive users, we're going to have those problems crop up, and then we can't really focus so much on advertising those specific innovation verticals because they're riskier. And anyway, you have to adapt to your current market, but for the time being, we're definitely seeing a lot of innovation participation, and it's for me personally, it's great to see.
And why do you think that's happening on Sonic? Is it the fee sharing model?
Maybe, but I think it's more just about the culture we set. Our team, Johan, Matt, Sam, myself, Mike, we've all at some point been some kind of DeFi builder, or just dApp builder in general. So we, I think, have a bit of a unique positioning. But as for an example, we're very active in trying to push the teams for composability. So where we see and identify potential areas where teams can work a lot closely together, we're the ones sort of driving that. We're the ones saying, hey, why don't you work with these guys? See what you can figure out here. How does this sound as a vault idea? How does this sound as a silo, as a pool, whatever it is? And I think the builders respond positively to that as well, as I would too, because it shows interest, it shows engagement, it shows understanding, and I think for a lot of these guys, they've felt very isolated over the last few years on other chains, where they're sort of on their own island building their own thing. No one's really trying to interconnect them or communicate, and then it just gets a little bit lonely, and like you lose the excitement, right? A perfect example now, Silo is our biggest lending market, and we push them really hard. Great team. And now Aave launched, right? So now automatically it's like, okay, well, Aave is sort of the more traditional one. But I think in another chain, focus would have now shifted. But for us, not only are we suggesting ways that those two can work in parity. So for example, Silo can start onboarding assets that it can use as collateral, that it can then do other long tail strategies with assets that Aave might not want to onboard. Or they can have higher LTVs because they have more isolated risk functions. But we're actively sitting with them, figuring these things out and how to do it and how to keep everyone engaged and functioning on all cylinders, instead of just like, oh, okay, well, you guys are on your own, good luck. And I think we're seeing just a good response to that. And, also being open to telling these guys, hey, try something new. We're not just saying, no, only use, 100x audited code from the last cycle because we don't want to create any risk. Or if you do something like that, we won't endorse you or whatever. Try new stuff. Just make sure you keep your users informed. We don't mind pushing people to high risk stuff. They just need to understand why it's high risk.
Love it. Yeah. So pivoting a little, want to ask about metrics, since you touched on that. What would you consider to be the most important metrics you track, both on the chain level or protocol level?
Well, depends on each vertical, right? For a lending market, you care about interest rates. How low are they shows you how healthy a given market is. With that, you need to take into consideration, active liquidity, because 1% interest on 100 available USDC isn't exactly a healthy market. So you can't really, there's no one metric to rule them all, right? It's the same anywhere. On a chain level, at certain points you look at throughput, how many transactions are going through there. But for me, more important is gas price, because that is more a measure of what are people willing to actually pay for the activity they're doing on chain. And even at any given point in time, if we want, we can activate a bunch of bots that spam the network so that we're always at like 10,000 TPS, but that doesn't achieve anything. and that just creates congestion that might be less of a positive experience for someone else. So gas, definitely something that's measured. Gas price specifically. Gas usage is another thing that's measured, because I think that's, at the end of the day, probably a more important metric in terms of actual activity, because you can have 10 transactions that each do 1 million gas, or you can have 10 transactions that each only do 20,000 gas. And those two things are very different. Oh, dude, there are so many different metrics. I mean, on an AMM, obviously you're looking at volume, you're looking at spread, you're looking at liquidity, lending market, we've said, interest rates, liquidity, options markets, you're looking at premiums, you're looking at available liquidity, perps, you're looking at funding rates, you're looking at HLP or JLP or GLP, whichever liquidity pool they have. You're looking at those fees, you're looking at on-chain liquidations, your aggregators, you're looking at swap volume, you're looking at pricing, you're looking at routes. There's just too many metrics, I think, that to be able to say these are the top three, because you have to be specific to the vertical in which you are measuring.
Yeah, specific and holistic. Are there any, or which metrics? I know you said you can't pick three. When looking at a chain level specifically, which measures of activity or usage do you consider to be the most difficult to fake, like the highest signal? Because I know there's, like you mentioned, TPS can sometimes be.
No, you could fake all of them. No, all of them are very, very easily fakeable. I mean, if you're measuring gas per second, I can make transactions that are absolutely at the gas threshold, but I only need to send one every second. If it's TPS, I can just spam the network with transfers. If it's gas price, I can just bet higher than everything else. I'd say gas price is probably one of the harder ones because it's going to cost you the most to fake. The next most expensive one to fake is probably gas amount, because again, that costs you the most. The easiest one to fake is TPS, because you can just spam low value transactions. I guess it's similar to telecommunications, right? Like telecommunications networks, the thing they generally measure is how much bandwidth is being used, and that's a function of megabytes. So how much data is being transferred, and it's similar on chain, right? But data in chain nomenclature is gas. So that's probably the one you'd be measuring to actually indicate, on-chain activity. But I mean, a flash loan transaction that liquidates something is very, very high in gas usage, but that's not real on-chain activity, right? That's just a function of some back office feature that's running. I don't really think you can measure it at a chain level. I think where you measure it is at the user facing side, right? Like if, let's go back to the telecommunications argument, like when you're measuring data used, that's a secondary metric. That's, people aren't using the data because they're using the data. They're using it because they're streaming Netflix or YouTube or whatever. And it's the same on chain. You want to measure those user focused points that are generating that data. So for me, I mean, even when if you go look at my feed and stuff, when I talk about Sonic, I'll sometimes mention the underlying chain metrics, but 99% of the time I'm talking about the app or the user experience or something cool they did or how they removed a barrier for their users. Because those are the knock-on effect things, that's what ultimately influences how much gas is used or how many transactions per second or those kinds of things. But most of those metrics are kind of fugazi, right? I mean, I can give you metrics of a blockchain that has the highest TPS and the most gas used without a single app used by another user. And we see that sometimes, right? Like I often on DeFi Llama, I'll check a metric and I'll see like a chain on like top 2 or 3 that I've literally never heard of, and no one I know knows about it or has ever used it, but it's there on the numbers. And then, it's some obscure, I don't know, maybe app in China or something that,
Yeah.
isn't even in English, that I've never heard of. So,
What about app revenue? So it's the sum of the revenue on all the apps on the chain.
yeah, but also, what do you measure as app revenue, right? I mean, let's take something like Uniswap, for example. Is app revenue the 0.3% fees that are being paid out to the LPs on top of each swap, or is app revenue the 15% they charge on top of fees if you swap in their UI? VE33 apps are always really high on the revenue, but that's because they're actually just stealing the revenue from the LPs and paying that to the token holders, and then the token holders are voting emissions. So, like is it EBITDA? Is it like a net of the LP minus, token subsidies? We don't have a clean way of measuring it right now. And again, I can, if you tell me the metric you're optimizing for, within half an hour, I'll propose for you an app that is optimized for that metric. In many ways, that's one of the things our VE33 also came out, because it's like, how do we optimize for app revenue? And that's how you optimize for app revenue. So those apps earn a ton of, in quotes, app revenue, but it's subsidized money going to, the stakers who are willing to sort of take the long-term token bet against the short-term fee bet. Again, like until we have a standardized unit of measure for that, I think it's hard. And I think the only real standardized measure of unit we can use for that is how much money is going to the DAO, or company or entity or whatever it is. And for some, that's easy to measure. For other, that's hard to measure. So in the Uniswap example, that'll be the 15% they get via their UI. Most of that isn't even happening on chain. So like, it's hard to capture. For something like Aave, that'll be the 10% of fees they take from the interest rate paid that goes into their DAO. Those are clean examples because they don't add any weird, token stuff. For something like Shadow, which is a VE33, it'll be the amount of the fees that's paid out to their amount of stake to Shadow, because that's what their DAO is getting, offset by the cost of the emissions that their own DAO is being, diluted by. And then you can kind of get to a net number, but you can see it gets harder and harder to measure depending on how it's designed. Even in the real world, right? Like, I can design an app where you give me $1 million in revenue, and then I give you something worth $1,001 in the back end. So like, now all of a sudden I have a company that's earning $500 million a year, but after costs, I'm actually at like minus 500.
Yeah, no, I totally see what you mean. I never thought of it that way of looking at revenue to DAOs and then subtracting emissions from the token holder revenue.
Well, I
know we're starting.
We unironically need like an SEC level standardization of like, filing returns and stuff, but it's just unlikely to happen. You can obviously measure a lot of the stuff on chain. That helps a ton, but even then you can play a shell game with fees. So
yeah, absolutely. Especially people incorporate bribes and all those things. So you've of course started a number of projects in your day. A lot of founders or people who are otherwise involved in DeFi projects watch this channel. What advice would you give to them?
Jesus, that's an interesting one. What advice would I have given to myself? Probably, I think the highest ROI thing I've done is probably my blog and my Twitter/X now, where I wasn't doing that stuff to build an audience. I was just writing notes for myself. My blog I used to write my thought process when I'm busy designing something new, or after I designed it, I'm sort of writing how I would do a README for it. My Twitter and now X, I sort of used as a as a chronology where I would, just make a note of when I release something new, or if I hit a cool metric, or so that I always have that kind of timeline I can refer back to. And I think doing those things publicly at the start, when I had a low following, was great, because I had a bunch of obviously very technical people, and they helped a lot with ideation, with discussion, and all of those kinds of things. Fast forward, it will change as your audience changes. You need to recognize that. When you have a small niche audience, you'll have very high quality conversations. When you're at, I don't know, 400 or whatever I am now, 1,000, it's a lot more noise. You can't really have those conversations anymore. But now, now I have an audience that I can also sort of maximize for if I do new things to test with. So that was probably the highest sort of ROI thing I did. It's just that I put all of those thoughts and ideas just out in the open and in the public while I was building, which I think helped a lot. But other than that, it's about experimentation. It's about sunk cost fallacy is definitely a big one. Like, don't just keep throwing good money after bad. Like, realize when you need to pull out of something. Yeah, be willing to accept when you're wrong and be willing to try new things. That's ultimately sort of the founder mentality.
That's great. The thing about building in public is interesting. Aside from the lower quality conversations or having a more difficult time finding good conversations, are there any downsides to that?
Oh, there's a ton of downsides. I don't know. I mean, along with that comes relentless attacks. You'll have people that wish upon you the most gruesome stuff that I won't even repeat on this call for no reason. If you launch a project that has a token, you need to accept your value is only as good as that token. When it goes up, you're the messiah of DeFi. You're an absolute god dev. When it goes down, you need to just kill yourself and everyone that you've ever interacted with. No, it's brutal. You'll go through a lot of lessons learned. For example, at the start, if someone said something negative, I would go out of the way to message them. I try and understand why they're saying what they're saying. I'll try and identify their problems. I'll try and address it. And I'd say 99% of the time, there was always a positive outcome. So at the start, I was capable of keeping, let's say, 90% of my audience happy. And that was awesome to me. And I tried to optimize for that. But as time went along, I quickly started to realize that a part of my audience is just there because they want to see me fail. And I realized that the conversations I was having, so I was applying the same logic. I try and message them, I try and go through stuff. They would just use that to amplify their own engagement, or they would realize, oh, that works, let's do more of that. So all of a sudden I went down to, okay, cool, I need to keep 51% of my audience happy. And then I stopped caring that deeply about what people said. And I started shifting from private conversations to public conversations. So where I felt the need to address something, I would address it in a public reply to someone, which was already a big difference. And that again worked for a while. At the size I'm at now, I'm applying the Pareto principle. I try and keep the 20% of the value happy. And that other percent honestly is noise. And as you evolve, you're going to have to, go through those lessons. And those lessons were hard to learn. There's at that sort of shift between 90 to 51, there's many depression cycles I went through, self-abusive cycles I went through, a bunch of bad stuff, but eventually your brain sort of adapts for it. And then when I went from the sort of 51 to 20% principle again, deep depression cycles, it's like anything else in the world, right? Like your mind, your body, everything has to adapt to the current frictions that you are suffering. I do still think it's ultimately worth it. I do just think you as a person doing that in public just need to sort of, I think it would have it wouldn't have been easier, but I think the journey would have made more sense if someone had told me that at the start, that is going to happen and it's okay when it happens. I think that's the biggest problem, right? Because like a lot of the times when I shared stuff publicly, people will always privately message you and be like, oh, ignore the loud majority. There's a minority. There's a silent majority backing you, blah, 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 blah. No offense, silent majority doesn't fucking matter because they're silent. You can't measure them. It's that simple. It's like, it's the tree that falls in the fucking woods. Did it really fall? It's the old philosophical argument. It's exactly the same. But if I just had someone that told me that, look, this stuff is going to be bad, it's going to be shit, and that is okay. It is okay. I think that would have helped a lot. It's not going to magically make it go away. It's not going to make you feel better, but just knowing that eventually it is going to be okay. But it's hard. But anything worth doing is hard.
Mm-hmm. Mm-hmm. Yeah, no, it is tough. I have a much smaller profile than you, but even with 50,000 on YouTube, you know, comments. Some days I'll be like, I don't want to read comments because one comment will ruin
that. It ruins your day. There can be 90,000 good ones saying, "Hey, awesome video," and then that one that's like, "Oh my god, you piece of shit, just go like suffocate yourself." Like, dude, why?
Basically, yeah.
I know, been through that.
Yeah. Last question. Aside from what you're working on now, what do you think are the most interesting problems that DeFi builders could work on today?
On-chain derivatives, I think, is a big one that's not been properly solved yet. I think what AMM did for trading, we're still going to see for options, on-chain perpetuals, lending even. I think there is still a lot of innovation that needs to happen on the tokenomics side. You know, to date, we've kind of just been replicating traditional equity models. And I mean, it says something that like VE33 is probably one of the most successful tokenomic models. I mean, there's even blockchains built on the premise. There's still a lot more there to do. Insurance, I think, is another one that we will need to still tackle on chain. And I think it's largely due to insurance primitives are front loaded. So what I mean by that is, you know, you often have to pay all of your premiums for the whole like cycle of the contract in advance, and that just doesn't make economic sense. I think those are the immediate sort of DeFi builder ones. Beyond that, you know, I think gaming on chain right now is sort of reminiscent of the early 2000 Flash era. I think those are going to keep evolving, and I think that's definitely an interesting problem. But those are a little bit limited to the underlying chain capacity. So you need those lifts every single time. But I'd say those are probably the two big ones we'll see over the next 12 to 24 months.
Phenomenal. Thank you, Andre. It's been great to have you on. Appreciate you taking the time out of your day to join us here. And thank you, everyone, for watching. People probably know where to find you, but just in case, where can they find you?
Yeah, the best place normally to start on my Twitter. Everything flows from there. You know, I've got all my handles on my bio, websites, apps, Linktree, Telegram, all that stuff. So what is my Twitter? Andre Cronje Tech. Yeah. So name, surname, Tech.
There you go. It'll be linked down in the description as well. Thanks again, and have a wonderful day.